Rupal, maybe you can sit downstairs in the.
Yeah, now we are going live, Samir. Good morning, everybody. A very warm welcome to this meeting of Baroda Book Browsers. I hope that all of you are taking adequate care to stay safe and to stay fit and healthy. Uh, we are set for our today's book review meeting. Name of the book is Psychology of Money. Reviewer of the book is Samir Shah. Let me begin by giving a few sketch lines about Samir. Samir is a very veteran book reviewer at Baroda Book Browsers forum. I think having reviewed some 14 books already. This is his 15th book. He started reviewing a book probably in 2002. So his association with us is for almost 2 decades now. Samir, by qualification, is an IITian from Mumbai, a graduation he did there. Then he went on to did his master's in organizational psychology and theory from Carnegie Mellon in US. Then he came back and founded, ran very successfully a chain of eye comprehensive eye care clinics with the name New Laser Vision Clinics until 2015, where he was very ably supported and backed by his professional doctor wife, Rupal. And since 2015, he is now associated as a professional director in Center for Sight, where his wife continues to be a very active and main professional orthopedic surgeon. So that's about Samir. But more importantly, since 2015, he has changed his track of career or life. So I would say by becoming a very astute investor and trader. So since 2015-16, he has dived very deep into the arena of investment fields, and he is one of the very active traders now and very successful at that. Besides this, Samir is an avid traveler and, of course, voracious reader. As 14 books that he has reviewed at Baroda Book Browser itself is emblematic of that. So that's about Samir. Uh, I will not talk much about this book, and I will leave it to Samir to get into the details and the aspects and sage wisdom concerning the behavioral aspects relating to the investment. But suffice it would be for me to just make beginning remarks to say that the central premise of this book is that doing well with money has, contrary to the popular perception, it has little to do with how smart you are. And in fact, the author says a lot to do with your set of behavioral skills at crucial junctures of times when you have made choices about investments. Uh, he also says that a behavior is something which is very difficult to teach, and it cannot be taught in any school of management. Uh, he goes on to say this premise with some 18 short stories and anecdotal evidences, which I'm sure Samir will deal with in this book. The author further amplifies how crucial is the behavioral skills control and monitoring by an individual who wants to be a wise and astute investor. And he says that a genius who loses control of his emotions at a given particular point of time, or different points of, can bite the dust and can end himself in disaster, as far as the investment is concerned. And the opposite is true in the sense that even ordinary folks with very little or no financial management skills can, with a handful of behavioral skills that have nothing to do with their education, can in fact result in their being very successful investors. So this is the central theme of the book. Before I hand over to Samir to carry out this book review, let me bring to your notice, about a month back, I received through WhatsApp University one of the very important posts. It was some 22 tips provided by Nilesh Shah, who is the group president and CEO of Kotak Mahindra Asset Management, a very respected with Gujarati background and innate, financial behavioral skills. Most Gujaratis do have. If you want to know about, what it takes to be a good, sound, long-term, fruitful, successful investor you want to be, please go through those tips, apart from, of course, reading this book. Without further ado, now may I invite Samir onto this virtual stage, and please carry out the book review. Over to you, Samir.
Thank you very much, Sunil Bhai. It's a real, it has been a 2-decade long association with Baroda Book Browser, something which I value. And I'm so glad that I'm again reviewing a book. At least it has given me a chance to, take about 15 books and actually read them threadbare, much more detail than I might have otherwise. And that's been a valuable experience as well. When I told Sunil Bhai about this book, I hadn't actually read it, and I just heard about it, and I did not actually read it. And when I read it, I realized that it's actually a little difficult book to review, because many of the ideas are commonsensical. They're not something earth-breaking or something technical which you can figure out and which you didn't know. Most of them are ideas about things which all of us know at the back of our minds, but we don't, of the difficulties in actually behaving in this manner as the book prescribes. The other difficulty is that the book has about 18 short ideas, and these are somehow intertwined with each other. And normally, if I would review a book, I might leave out one or the other thing because it's not so important to the core of the book. But here, it's very difficult to leave out any one of those ideas. And so I have to sort of rush through the book, because it does mean that I would like to give you all the ideas instead of just a few. But I'll give it a shot. And so without further ado, let's just jump into the book as such. Sunil Bhai, am I clear, audible, the screen is visible, everything is all right? Okay, I don't think Sunil Bhai is there, so I'll just go ahead and start off. So the first chapter is entitled The Greatest Show on Earth. And why is it called that? Okay. So the premise of this book is that doing well with money has little to do with how smart you are, and a lot to do with how you behave. And behavior is hard to teach. Even to really, really smart people, behavior is hard to teach. A genius who loses control of their emotions can be a financial disaster. The most common example of such a genius is Isaac Newton, who lost his entire fortune in the South Sea bubble, this massive financial bubble that had occurred in England in the 17th century. The opposite is also true. People who are not clever but who have full control of their emotions can be extremely financially successful. Ordinary folks with no financial education can be wealthy if they have a handful of behavioral skills that have nothing to do with formal measures of intelligence. The author comes with two examples. One is a guy called Ronald Reed. The another is a guy called Richard Fuscone. So Ronald Reed was a janitor. He had just high school level education. He was a janitor who used to clean the floors He married, he bought a house for $12,000 and stayed in that house for his whole life. He married, he got widowed at 50, he didn't remarry, and his favorite hobby was cutting firewood. And Richard Fuscone, on the other hand, was a Harvard-educated Merrill Lynch executive who made so much money by the age of 40 that he retired and turned to philanthropy. But guess what happened towards the end of their lives? Ronald Read used to save a little bit of money every year and used to put it into blue chips, while Richard Fuscone, after he retired, decided to spend money on a large house, borrow money, and so on, because he was so confident that he could always keep earning money. And ultimately, Ronald Read ended up being a philanthropist who donated $6 million at the end of his life to charity, and Richard Fuscone went bankrupt. So Ronald Read was patient and Richard Fuscone was greedy. That's all it took to eclipse the massive education and experience gap between the two people. So the author says that this is the greatest show on earth, because in what other industry does somebody with no college degree, no training, no background, no formal experience, no connections massively outperform someone with the best education, the best training, and the best connections? You can never have a story of a janitor outperforming the world's top nuclear engineers, or a janitor who suddenly goes and designs a spaceship. This is not possible, but it's possible to be successful in the investment in the business. So why does that happen? So one is that, of course, financial outcomes are driven by luck. So at least a part of our financial outcomes are driven by luck, independent of any intelligence or effort that you put into it. The other is that financial success is not a hard science. It's not something where you can say X plus Y is equal to Z. It doesn't work that way. It's a soft skill where how you behave is more important than what you know. And what the author calls a psychology, this soft skill is what the author calls the psychology of money. And that's the aim of this book. The aim of this book is to use short stories to convince you that soft skills are more important than the technical side of money. Knowing what to do in a particular situation tells you nothing about what happens in your head when you try to do it. And so it's extremely important to understand what happens in your head and try to make sure that it is driven by what is reasonable. We think about and are taught about money in ways that are too much like physics. So we are taught that you have this spreadsheet of interest rates go up, bond prices will fall, and so on and so forth. But we are not taught it like psychology, with emotions and nuance. Few topics offer a more powerful magnifying glass that helps explain why people behave the way they do with money. When you see what they do with money, tells you a lot about what those people are themselves. To grasp why people bury themselves in debt, you don't need to study interest rates. You need to study the history of greed, insecurity, and optimism. I mean, I cannot understand why somebody would take credit card debt at 36%, but there are so many people in this world who do. To get why investors sell out at the bottom of a bear market, you don't need to study the math of expected future returns. You need to think about what that person must have felt about the agony of looking at your family and wondering if your investments are imperiling their future. So then they can't bear the uncertainty and get out. And so this is where the book now gets into the different aspects of the psychology of money. And the first chapter is entitled No One's Crazy. So he says that people do crazy things with money. They will buy a jet plane that they can't afford. They buy an expensive car that they can't afford. They might sell out at the bottom of a bear market, which in hindsight looks so stupid that they did it. But so people do these crazy things, but no one is actually crazy. Everyone has their own unique experience of how the world works. And what you have experienced is more compelling than what you learn secondhand. So I could tell somebody a lot that don't sell out in a bear market, but people have their own unique experience. And what seems crazy to me might make sense to them. That's not because one of us is smarter than the other, or that one of us has better information than the other. It's because we've had different lives, shaped by different and equally persuasive experiences. You cannot expect somebody who has been born in a country like India with shortage, with inflation and so on, to behave in the same way as somebody in the US who has always lived a life of plenty, for example. Our personal experiences with money make up a very, very tiny sliver of what's actually happened in the world. So how much do we experience of what's happened in the world? Very, 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 very small. But for us, it's 80% of how we think the world works. We value our own experiences much more than what we value the experiences of others. So equally smart people can disagree about how and why recessions happen, how you should invest your money, what you should prioritize in life, how much risk you should take, and so on. We all think we know how the world works. But the reality is that we have all only experienced a tiny sliver of it. Lots of economists' findings suggest that individual investors' willingness to bear risk, for example, depends on their personal history. Not intelligence, not education, not sophistication. Just the dumb luck of when and where you were born defines your attitude towards money and risk. So every decision people make with money is justified by taking the information they have at that moment and plugging it into their unique mental model of how the world works. Those people can be misinformed. They can have incomplete information. They can be bad at math. They can be persuaded by rotten marketing. They can have no idea what they're doing. They can misjudge the consequences of their actions. Oh, can they ever do that? Or they can do all of these things. But every financial decision a person makes sense to them in that moment and checks the boxes they need to check. The takeaway from this for the author is that, when you look at other people's behavior, don't judge it from your prism. You must plug it and see it from their prism. But let's now talk about luck and risk. Luck and risk are siblings. They're both guided. The reality that every outcome that we have in life is guided by forces other than individual effort. You can never say that I did this, it's my achievement and solely my achievement, because there was always some luck and some that happened to you and some risk that you took. And so that risk didn't actually pan out. Luck and risk are so similar that you can't believe in one without equally respecting the other. They both happen because the world is too complex to allow 100% of your actions to dictate 100% of your outcomes. We are in a world with so many different moving parts that it's very rare that your actions result in exactly the outcomes that you actually wanted. But both luck and risk are so difficult to measure, so hard to accept that they often go overlooked. It's very difficult to parse when you look at an outcome, what was the contribution of luck and risk to this? And they're so hard to accept individually also. I mean, we talk about the psychology in a minute, that they often go overlooked when you look at people. If you give luck and risk their proper respect, you realize that when judging people's financial success, both your own and others, it's never as good or as bad as it seems. Don't look at a billionaire and think that everything he does is right. Don't look at your actions and feel that everything you do is not right. No one actually thinks luck doesn't play a role in financial success. None of us believes that, right? I mean, all of us know that luck has a role in financial success. But since it's hard to quantify luck and root to suggest that other people's success is owed to it, the default stance is often to implicitly ignore luck as a factor of success. I mean, if you see somebody who's really successful, you don't go to them and say, oh, you are very lucky. You tell them that, oh, you are so smart that you did so many good things in life that you got so lucky at this thing. Right? Otherwise, it seems just very rude to tell somebody that, oh, you are just lucky. When judging others, attributing success to luck makes you look jealous and mean, even if we know that it exists. And when you judge yourself, suppose you did something which was very smart and very successful, when you judge yourself, attributing success to luck can also be too demoralizing to accept. And the same cases as it's with success, there's also a case of failure. Somebody else's failure is usually attributed to bad decisions, while your own failures are usually chalked up to the dark side of risk. If somebody else becomes an investment failure, you feel that, oh, those people took so much risk, they should never have taken it. If you become it, you say that, oh, if you lose your money, you say that, oh, I took a risk, but unfortunately for me, I became unlucky. When judging your failures, I'm likely to prefer a clean and simple story of cause and effect. If I'm judging other people's failure, prefer clean and simple stories of cause and effect. I don't know what's going on inside your head. But when judging myself, I can make up a wild narrative justifying my past decisions, attributing bad outcomes to risk. The dangerous part of not realizing this attribute of luck and risk is that we are all trying to learn what works and what doesn't with money all the time. We tend to seek out these lessons by observing successes and failures. So we like to say that, oh, I'd like to do what she did, avoid what he did, because she was successful and he was not. If he had a magic wand, we would find out exactly what proportion of these outcomes were caused by actions that are repeatable, versus the role of random risk and luck that swayed those actions one or the other. But alas, we don't have a magic wand. We don't have something which can easily pass the role of luck and risk from the outcomes. And this is not an easy problem to solve. The difficulty in identifying what is luck, what is skill, what is a risk, is one of the biggest problems we face when trying to learn about the best way to manage money. So one thing to do here is that you have to be careful who you praise and admire. Be careful who you look down upon and wish to avoid becoming. Or just be careful when assuming that 100% of outcomes can be attributed to effort and decisions. Therefore, focus much less on the specific individuals who got lucky or who became successful or failed, but more on broad patterns of what a broad group of people did to become successful and what a broad group of people did to become failures. That's much more useful when you look at your investing behavior. Don't take lessons from extreme cases. Don't take lessons from that Fortune 500 chief executive or the billionaire or Mukesh Ambani or who have you. The more extreme the outcome, the less likely you can apply its lessons to your own life. Because most likely that outcome was influenced by extreme ends of luck or risk. You will get closer to actionable takeaways by looking for broad patterns of success and failure in situations which are relatively more common in life. Not those extreme cases of failure or success, but the more ordinary cases of failure and success. The more common the pattern, the more applicable it might be to your life. But the most important thing is that as much as we recognize the role of luck in success, the role of luck also means that we should forgive ourselves and leave room for understanding and judging failures. When you're talking about other people, don't judge them too harshly. So now this is the next chapter, Never Enough. So one of the things the author says, a very interesting anecdote that he gives is that Joseph Heller, who's the author of Catch-22, a very widely successful novel of its time, basically went to a hedge fund manager's party. And one of the guests there tells him that, Mr. Heller, this man earns as much money in one day as you earned in the whole of Catch-22's lifetime sales. So Heller says that, yes, that's true, but he will never have something that I have. Enough, he says, enough. For a critical element of our society, including many of the wealthiest and most powerful amongst us, there seems to be no limit today on what enough entails. Okay, we don't understand what enough is for ourselves. He gives the example of Rajat Gupta and Bernie Madoff. All of us know Rajat Gupta and Bernie Madoff. They were highly successful people. They had everything. They had hundreds of millions of dollars already. They had unimaginable wealth, prestige, power, freedom. And they threw it all away because they wanted more. They had no sense of enough. You can understand if somebody who's on the edge of survival does something criminal, because you can understand that they had to take some big bet to be able to come out of that orbit. Here, these people were already having prestige, power, freedom, and they threw it all away because they had no sense of enough. And this is one of Warren Buffett's quotes, that he says that to make money that they didn't have and didn't need, Bernie Madoff and Rajat Gupta risked what they did have and did need. See what a powerful sentence it is. To make money that they didn't have, didn't need, they risked what they did and have and did need. And that's plain foolish. If you risk something that's important to you for something that's unimportant to you, it just does not make sense. Get the financial goalpost to stop moving. Don't say that I have today 50 crores today, so I must have 100 crores. Then I'm not satisfied. I should have 100 crores. 100 crores, when you get, you say that no, this is not enough. I need 1,000 crores and so on. It doesn't work that way. Few of us will ever have $100 million, as Rajat Gupta or Bernie Madoff did, but a measurable percentage of us who are listening to this review will at some point in time in their life earn a salary of a sum of money sufficient to cover every reasonable thing that they need and a lot of what they want. Okay. We all are comfortable. The hardest financial skill is getting to this goalpost to stop moving. Because modern capitalism is a pro at two things. One is that it allows you to generate wealth, and the other is that it generates envy. But life isn't fun without a sense of enough. Happiness is just results minus expectations. So if you want to be happy, lower your expectations. Social comparison is a dead end. It's a problem here. First of all, the ceiling of social comparison is so high that virtually no one will ever hit it. If I have X amount of money, I then look at people who have more than me. That when I reach that point, then I'm looking at somebody more than that, and there's always somebody higher. Even Warren Buffett cannot claim to be the richest man in the world, which means that it's a battle that can never be won, or that the only way to win is not fight it to begin with. So don't engage in social comparison, because it's not a great way to actually make investment returns. Enough does not mean that it's too little, but you have to understand that it's enough. Enough is at least that much that you don't risk your reputation, your freedom and independence, your family and friends and happiness for the sake of more and more. The good news is that the most powerful tool for building enough is remarkably simple and doesn't require taking risks that could damage any of these things like reputation, freedom, your family, and happiness. And that's compounding. Okay? If something compounds, if a little growth serves as a fuel for future growth, a small starting base can lead to results so extraordinary that they seem to defy logic. It can be so logic defining that you cannot underestimate what's possible, where growth comes from, and what it can lead to. And so it is with money. Warren Buffett made 81.3 million out of his 81.5 million after the age of 60 or after the age of 50. Right? So he made most of his money much later in life than he did in the beginning. That's because of compounding. Buffett's fortune isn't just due to being a good investor, but being a good investor since he was literally a child. He's a phenomenal investor. He finds the right things to invest in, but miss a key point if you attach all of his success to investing acumen. The real key to his success is that he's been a phenomenal investor for 3/4 of a century, a period which is not due to many, many people. His skill is investing, but his secret is time. That's how compounding works. And so when we are studying why something got to become as powerful as it has, why an ice age formed, or why Warren Buffett is so rich, we often overlook this key driver of success. Most people don't understand the counterintuitive nature of compounding. Even the smartest people don't overlook its power. In fact, Einstein called it the eighth wonder of the world. The danger here is that when compounding isn't intuitive, we often ignore its potential and focus on solving problems through other means by trying to make high rates of returns without making sure that we are there for a long time in the game. The practical takeaway from this is that average returns are simply good enough. The practical takeaway is that counterintuitiveness of compounding may be responsible for the majority of disappointing trades, bad strategies, and unsuccessful investing attempts. But good investing isn't necessarily about the highest returns, because the highest returns tend to be one-off hits that can't be repeated. I invest in Tesla in 1 year, money becomes 10 times, but I can't find the next Tesla easily. So it's about earning pretty good returns that you can stick with and which can be repeated for the longest period of time. That's when compounding runs wild and gives you this tremendous amount of wealth. So now let's talk about getting wealthy versus staying wealthy. Good investing is not necessarily about making good decisions. It's about consistently not screwing up. Okay. There are a million books out there to get wealthy. Plenty of books on how to do so. Okay. But there's only one way to stay wealthy. Some combination of frugality and paranoia. Getting money and keeping money are two different skills. Getting money requires you to take risks, being optimistic, putting yourself out there. Okay. But keeping money requires the opposite of taking risk. It requires humility and fear that what you have just made can be taken away from you just as fast. Keeping money requires frugality and an acceptance that at least some of what you made is attributable to luck. So past success cannot be relied upon to repeat indefinitely. Not growth or brains or insight. The ability to stick around for a long time without getting wiped out or being forced to give up is what makes the biggest difference. More than I want big returns, I want to be financially unbreakable. If I'm financially unbreakable, I will be there for long enough. And if I'm unbreakable, I actually think I'll get the biggest returns because I'll be able to stick around long enough for compounding to work wonders. Because the thing about compounding is that it's backloaded. It's not front-loaded. Planning is important. You have to plan your life. But the most important plan of every plan should be to plan on the plan not going according to plan. Sorry, I didn't get this quite right, but you understand what I mean. A barbelled personality, a personality which is optimistic about the future and its center, but paranoid about what will prevent you from getting to the future in the first place is vital. A mindset that can be paranoid and optimistic at the same time is hard to maintain because seeing things as black and white takes a less effort than accepting nuance. But you need short-term paranoia to keep you alive long enough to exploit long-term optimism. Finally, now there's a unique aspect of investing, which is tails you win. You know, we all have heard of heads you lose, tails you win, but this is the way tails you win is a great thing because in this case, the tails is about something other than a coin toss. So he talks about a story of a guy called Bergerain who made a tremendous amount of, who did nothing extraordinary in his childhood, in his student life, and in his life as such, but he eventually ended up donating about $1 billion worth of paintings to the German government. And so what he says is that how did this guy become successful? So he says that the great investors bought vast quantities of art. A subset of the collections turned out to be great investments and they were held for a sufficiently long period of time to allow the portfolio return to converge upon the return of the best elements in the portfolio. That's all that happens. Okay. And he says that a lot of things in business and investing work this way. Long tails. When you look at all the outcomes that are possible, there are very good outcomes, there are very bad outcomes, and then there are all these outcomes in between. But it's a long tails, the ones which are very good or very bad outcomes, which have a tremendous influence in finance. A small number of events can account for the majority of outcomes. It's not intuitive that an investor, for most people, it's not intuitive that an investor can be wrong most of the time and still make a fortune. It means that this is because we underestimate how normal it is for a lot of things to fail, which causes us to overreact when they actually do fail. The distribution of success amongst large public stocks over time is not much different than it is in venture capital. Just give you a small story. A relative of mine, for example, invested in all IPOs that happened in India in the late 70s, 80s, and early 90s. And ultimately, he died about a few years ago, he died, and then his family took out all these he had all these thousands and thousands of share certificates. And ultimately, it turned out that this modest man who had never earned much in his life had shares worth 15 crores of rupees. Because most of the companies were duds, a few did well, and a handful became extraordinary winners that accounted for the majority of his returns. The idea that a few things account for the most results is not just true for companies in your investment portfolio. It's also an important part of your own behavior as an investor. In your own behavior as an investor, you will find that a few things actually end up making the most difference to your portfolio. Most financial advice is about today. If you go watch CNBC, which I don't watch, they'll tell you what you should do right now, what stocks look like good buys today. But it doesn't matter at all. this what you buy today. Your success as an investor will become determined on how you respond to punctuated moments of terror. Did you sell all your stocks on March 23rd, 2020? Or you didn't? Not on the years you spent on cruise control. If you would just be on cruise control as an investor, most likely you will do well as an investor. A good definition of an investing genius is the man or woman who can do the average thing when all around them are going crazy. Tails drive everything. Okay. Tails drive everything. Investing does not require perfection. There are fields where you have to be perfect every time. I mean, if you are in an orchestra, you can't be having a false note every now and then. If you are a pilot, you can't do something wrong. If you want to be a surgeon, for example, you have to be at least pretty good nearly all the time. But investing, business, and finance are just not like those fields. You can be wrong half the time and still make a fortune. And that's something which one has to understand. Then why do we earn wealth? Okay, so why do we earn wealth? So what the author says is that the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want to do today. Okay. In other terms, it's called FU money, but I will not elaborate on that. People want to become wealthier to make them happier. Happiness is a complicated subject because everyone's different. But psychological studies have shown that if there's a common denominator in happiness, a universal fuel of joy, it's that people want to control their lives. The ability to do what you want, when you want, with who you want, for as long as you want is priceless. It's the highest dividend money pays. Money's greatest intrinsic value, and this can't be overstated, is its ability to give you control over your time. Now let's talk about what money doesn't get you. Okay, so he talks about this man in the car paradox. So when you see someone driving a nice car, you rarely think, wow, that guy driving the car is cool. Instead, you think, wow, if I had that car, people would think I am cool. Subconscious or not, this is how people think. But this is a paradox. People tend to want wealth to signal to others that they should be liked and admired. But in reality, those other people often bypass admiring you, not because they don't think wealth is admirable, but because they use your wealth as a benchmark for their own desire to be liked and admired. Okay. And so wealth does not actually give you this respect and admiration that you want. You have to have this subtle recognition that people generally aspire to be respected and admired by others. And using money to buy fancy things may bring less of it than you actually imagine. If respect and admiration are your goal, be careful how you seek it. Humility, kindness, and empathy will bring you much more respect than horsepower ever will. Wealth is not actually what you don't see. We tend to judge wealth by what we see because that's the information we have in front of us. So we can't actually see people's bank accounts or brokerage statements. So we rely on outward experiences to gauge financial success. We look at their car, we look at their home, we look at their Instagram photos, where they traveled, which hotel they stayed in, and so on. But the truth is actually that wealth is what you don't see. Wealth is the nice cars not purchased, the diamonds not bought, the watches not worn, the clothes foregone, and the first class upgrade declined. Wealth is financial assets that haven't yet been converted into stuff you see. That's actually wealth. I mean, think about it and it makes absolute sense. The only way to be wealthy is not to spend the money that you do have. It's not just the only way to accumulate wealth, it's a very definition of wealth. We have to define rich and wealthy differently. Rich is current income. How rich you are allows you to say buy a nice car, because even if you can't afford, if you borrow for it, you still have to have a certain level of income for you to be able to borrow. But wealth is hidden, it's income not spent. Wealth is an option not yet taken to buy something later. Wealth's value lies in offering you options, flexibility, and growth to one day purchase more stuff than you could do right now. So wealth is something which you are saving for a later day. If you think about dieting, I mean, many people do a lot of exercise and then sit down to have this nice treat meal because they burned so many calories. But wealth is actually turning down that treat meal and actually burning net calories. It's hard, it requires self-control. But it creates a gap between what you could do and what you choose to do that accrues to you over time. And over time, that becomes very, very powerful. The danger here is that I think most people deep down want to be wealthy. They want freedom and flexibility, which is what financial assets not yet spent can give you. But For most of us, it's so ingrained that money is to spend. The point of money is to spend it. That we don't get to see the restraint that it takes to be actually wealthy. And since we can't see it, it's hard to learn about it. People are good at learning by imitation, but the hidden nature of wealth makes it hard to imitate others and learn from their ways. The world is filled with people who look modest but are actually wealthy, and people who look rich and who live at the razor's edge of insolvency. Don't look at people by what they own. Keep this in mind when judging others' success and setting your own goals. And so the whole point about this is saving money. Past a certain level of income, people fall into three groups: those who save, those who don't save and think they can save, and those who don't think they need to save. And this is not, of course, for the people who save. I mean, I hope most of us do. But for the latter two, and I think there's an increasing number of such people in this world, this is a critical idea. The first idea, simple but easy to overlook, is that building wealth has little to do with your income or investment returns and lots to do with your savings rate. No matter if you earn 5,000 rupees, if you can take 500 rupees out of your 5,000 rupees, you're saving 10% of your income. That's your savings rate. Investment returns can make you rich. But whether an investing strategy will work or how long it will work for, whether markets will cooperate, is not always certain. It's shrouded in uncertainty. Today the market may work, tomorrow it may not work. But what will work is that if your personal savings and frugality, these are parts of the money equation that are totally in your control. You have a 100% chance of being as effective in the future as they are today. So a much easier way than seeking high investment returns is to seek a high savings rate. The value of wealth is relative. Wealth is just the accumulated leftovers after you've spent what you take in. And since you can build wealth without a high income, but you have no chance of building wealth without a high savings rate, it's clear which one matters more. It's a high savings rate which matters more. More importantly, the value of wealth is relative to what you need. If you are living simply, then you don't require a huge amount of wealth to be able to be happy. The same is true for incomes. Learning to be happy with less money creates a gap between what you have and what you want. Similar to the gap that you grow from growing your paycheck. I mean, suppose you are working somewhere and you want your paycheck to increase, but if you spend less, then you basically create the same gap. But this is much easier and much more in your control. Let go of that ego. Past a certain level of income, what you need is just what sits below your ego. Everyone needs the basics, of course. Once they are covered, there's another level of comfortable basics. That's another thing that everyone wants. Past that, there's basics that are both comfortable, entertaining, and enlightening. But I have a bet that in most of the people listening to this review, these basics are well covered. Spending beyond a pretty low level of materialism is only a reflection of ego approaching income. A way to spend money to show people that you have or had money. Think of it like this. One of the most powerful ways to increase your savings isn't to raise your income. It's to raise your humility. If you are humble, your savings rate will be high and you'll automatically start becoming wealthy. People with enduring financial success don't give a damn about what other things about them. Savings can be created by spending less. You can spend less if you desire less, and you can desire less if you care less about what others think of you. Okay. Now the author says that it's always better to be reasonable rather than rational. Why? What is the difference? It may be rational. For example, if you have a fever, your whatever reason to cause a fever will probably subside quicker if you don't allow that fever to subside. But if you go to a doctor, the doctor will give you something to bring the fever down because it's reasonable. People don't go to a doctor to have more fever. They want to get they want to be comfortable. Similarly, investing has a social component that's often viewed when you look at through only a strictly financial lens. You can't overlook in finance that something can be technically true and contextually nonsense. For example, I can tell you a strategy which will give you, you borrow 5 times the amount of money that you have and invest it in the stock market, and some of you will become incredibly rich because of that leverage. But it's contextually nonsense. You can't stick to that strategy if at one time you get a COVID-like fall and you lose everything, then what's the point of talking about that strategy? The math may work on paper, it's a rational strategy, but it's almost absurdly unreasonable. No normal person could watch 100% of the retirement evaporate and be so unfazed that they can carry on with the strategy undeterred. The reasonable investors who love their technically imperfect strategies have an edge because they are more likely to stick with those strategies. There are few, don't cause a dissonance between your heart and mind. If your heart agrees with your mind, then you're more likely to stick with it. There are few financial variables more correlated to performance and commitment to a strategy during its lean years. So anything that keeps you in the game has a quantifiable advantage, and not having this dissonance between heart and mind is more likely to keep you in the game. I'm running a little short of time, so I'll just maybe skip this bit. I'll take this and I'll skip the other one. Things that have never happened before happen all the time. We all know this. Things that have never happened before happen all the time. Who imagined in the beginning of 2020 that we would have that the year we did? History is mostly the study of surprising events. Obviously, if somebody writes the history of the 21st century, they're going to talk about the 21st century, second century. I don't know which century we are in. It's more, we are going to study. We are going to talk about the 2020. But it often is used by investors and economists as an unsaleable guide to the future. That's so ironic, because actually it's a study of surprising events. So it's smart to have a deep appreciation for economic and for investing history. History helps us to calibrate our expectations, study where people go wrong, offers a rough guide to what tends to work, but it is not, not in any way a map of the future. Investing is not a hard science. A massive group of people making imperfect decisions with limited information about things that will have a massive impact on their well-being. It can make even smart people nervous, greedy, and paranoid. Investors have feelings, quite a few of them. That's why it's hard to predict what they'll do next based on solely on what they did in the past. You can't look at past behavior and expect them to replicate exactly in the future. The most important driver of anything tied to money is the stories people tell themselves, the preferences they have for goods and services. And these stories don't sit still, they keep changing. They change with culture and generation. So experiencing specific events in the past does not necessarily qualify you to know what will happen next. In fact, it rarely does, because experience leads to overconfidence rather than forecasting ability. You will likely miss the outlier events that move the needle the most. The most majority of what's happening at any given moment in the global economy can be tied back to a handful of past events that were nearly impossible to predict. The global financial crisis, COVID, World War II, and so on. Not possible to predict these kinds of things. The most common plot of economic history is the role of surprises. The reason surprises occur is not because our models are wrong or our intelligence is low. It's not a failure of analysis, it's a failure of imagination. The correct lesson to learn from surprises is that the world is surprising. The correct lesson is not to use past surprise as a guide to future boundaries. But we have to use past surprise as an admission that we have no idea what might happen next. History can be a misleading guide to the future of the economy and the stock market because it doesn't account for structural changes that are relevant to today's world. And so learn from broad patterns in history, things like people's relationship to greed and fear, how they behave under stress, how they respond to incentives tend to be stable in time. The history of money is useful for that kind of stuff, but don't look at it as things about guides about what to do in a specific situation. I'll just, yeah. So now let's talk about nothing's free. Okay, the two things that this thing is that I skipped is that one was that you should always have a room for error. You have to keep a margin of error in how you deal with investing because you will have problems occasionally, and it's best to keep a margin of safety. And the other thing was that you will change, so you accept that you will change and do things which are not likely to change much and keep giving compounding a chance. But this is a critical idea. Nothing's free. Like everything worthwhile, successful investing demands a price. But its currency is not dollars and cents. It's volatility. It's fear. It's doubt. It's uncertainty. It's regret. It's that huge fall in the index in March of 2020. All of which are easy to overlook until you are dealing with them in real time. I know people who sold their entire portfolios on 23rd of March, the low of the market. Okay. You have 2 days of dealing with this price that is demanded by the market. Either you accept the uncertainty and live with it, or you find an asset with less uncertainty and a lower payoff. Of course, if you can invest your money in a fixed deposit and have a lower payoff and never have all this risk. Okay, but if you want a higher payoff, you have to accept the uncertainty. Many people in investing actually choose a very bad third option. They form tricks and strategies to get the return without paying the price. They trade in, they trade out, they attempt to sell before the next recession, buy before the next boom, but these guys rarely ever succeed. If they succeed, it's mostly because of luck. Market returns are never free and never will be. They demand you pay a price like any other product. You're not forced to pay this price. You can stay out of the game. You can choose very safe investments. But if you choose to play the game, you need to pay the fee. The volatility, uncertainty fee, the price of returns is the cost of admission to get returns. The trick is convincing yourself that the market's fee is worth it. That's the only way to properly deal with volatility and uncertainty. Not just putting up with volatility and uncertainty, but knowing that because of volatility and uncertainty, I'm going to actually make more returns. Realizing that the admission fee is worth paying. There's no guarantee that it will be. You will enjoy yourself at Disneyland if you pay the admission fee, but occasionally it will rain at Disneyland. Final thing that I would like to talk about is that investors, about you and me, right? Investors often innocently take cues from other investors who are playing a different game than they are. Beware the notion that assets have one rational price in the world where investors have different goals and time horizons. When investors have different goals and time horizons, and this is true in every asset class that you can think of. And prices that look ridiculous to one person can make sense to another because the factors those investors pay attention to are different. Okay. Bubbles form. We keep talking about bubbles in financial markets. Of irrationality. No. Bubbles form when the momentum of short-term returns attracts enough money that the makeup of investors changes from mostly long-term to mostly short-term. That process feeds on itself. As traders push up short-term returns, they attract even more traders. Before long, the dominant market price setters are those with the shortest time horizons. For them, it's rational to pay that price because they don't expect to hold the stock for 30 years. They expect to hold the stock for maybe 15 minutes. The formation of bubbles isn't so much about people irrationally participating in long-term investing. They're about people rationally moving towards short-term trading to capture momentum that has been feeding on itself. What do you expect people to do when momentum creates a big short-term return potential? Would you not invest in this period, for example, that we are experiencing in markets? Would you sit and watch patiently? Never. That's not how the world works. Profits will always be chased. And short-term traders operate in an area where the rules governing long-term investing, particularly around valuation, are ignored because they are irrelevant to the game being played. They don't care about valuation because they want to just make the short-term return. It is in fact bubbles do their damage not because of these short-term traders. Bubbles do their damage when long-term investors playing the long-term game start taking their cues from short-term traders playing totally another game. Okay. So when somebody who is there for the long run, who's actually thinking about their retirement money, starts saying that, okay, I'll buy these crazy stock with crazy valuation because everybody is stably making money. That's the problem. Okay, so find out which game you're playing. It's hard to grasp that other investors have different goals than we do because an anchor of psychology is not realizing that rational people can see the world through a different lens than your own. One of the things that is built into us is that we think that everybody thinks the way we do. But in fact, people have different goals than we do. And the main thing that can be recommended is that you should go out of your way to identify what game you are playing, for what time horizon you are playing it. Okay. All right. Sunil bhai, do I have 2 minutes or should I wind up?
Yeah, 2 minutes are fine. Please go ahead.
So now the final one, which is the seduction of pessimism. Optimism is the best bet for most people. In the world, it's best to be optimistic because the world does tend to get better for most people most of the time. I remember a book that was reviewed in Baroda book browsers called Factfulness by Hans Rosling. And Rosling so clearly demonstrated through that book that optimism is the best bet for most people. The world has gotten so much better in the last couple of 100 years. But pessimism holds a special place in our hearts somehow. Pessimism isn't just more common than optimism. It also sounds smarter. It's intellectually captivating. It's paid more attention than optimism, which is often viewed as being oblivious to risk. Somebody who's too optimistic is viewed as a foolish person because people feel that they're oblivious to risk. John Stuart Mill said in the 1840s that I've observed that not the man who hopes when others despair. I've observed that not the man who hopes when others despair, but the man who despairs when others hope is admired by a large class of people, persons as a sage. The one who keeps raising an alarm is the one who is considered to be a sage. Why is pessimism so seductive? Evolution is one reason for pessimism to be seductive. Organisms that treat threats as more urgent than opportunity have a better chance to survive and reproduce. So we also think of somebody who points out threats to us as being better for us than no otherwise. Another reason for, especially in the financial markets, that money is so universal. So something bad happening tends to affect everyone, captures everyone's attention. And one reason is that pessimists often extrapolate present trends without accounting for how markets adapt. They'll tell you that, oh, the world is going to run out of oil, not realizing, for example, that oil, new finds will come up and so on and so forth. Assuming that something ugly will stay ugly is a very easy forecast to make, and it's very persuasive as a forecast. We also get very easily persuaded by it because it doesn't require imagining the world changing. And the last reason why pessimism is seductive is that progress happens too slowly to notice, but setbacks happen too quickly to ignore. Investment returns are similar. Investment returns go up a staircase but fall down an elevator. Okay, and so it's often people tend to remain pessimistic rather than optimistic because of that. But what the author says is that the best chance for you to actually make money is to remain optimistic for the long run. Okay, so I think I will just end it here. I want to just talk about the final, just winding up. I'll just talk about a book written in the 1920s called The Richest Man in Babylon. It's a free book. You can read it on Kindle free of charge. And I think you should read it once because it was the most famous personal finance book of its time. And it has an enduring wisdom embedded in it. And the author and The Richest Man of Babylon says the same thing, that live within your means, make money work for you, safeguard your wealth, and so on. I mean, this is so personal finance wisdom is not something that is new, but Morgan Housel has brought some important nuances to it. He tells you what your behavior should be to allow you to make compounding work. It's easy to say compound your money, but many people interrupt the compounding unnecessarily. And Morgan Housel tells you a lot about how you can modulate your behavior so that you can save more, you can compound your wealth more, and have more happiness in your life. Thank you.
Thank you, Samir. Brilliant stuff. Awesome. That's how I can immediately exclaim after, watching and listening to you carrying out a very fluent, lucid, and yet very comprehensive review of the book Psychology of Money. You covered so many aspects relating to the behavior traits and important nuances that they will be very, very useful and will help people to etch in their mind how it is at the end of the day your behavior control and monitoring which will sell you through to navigate in the wonderland of investments. Before I take up the questions from the audience, Samir, I will just invite you to the last concluding chapter of the author, in which he gives a heading confessions, and he says managing my own money's psychology. And he quotes one very important consulting group in investment, First Manhattan, and their CEO normally he doesn't ask a question to a new recruitee who will be managing the investments of his clients, something like what stocks do you think are cheap, or what economy is about to have, or whether the economy is about to have a recession. Instead, he asks generally that what do you do with your money? And his explanation is that the author says, I love this question because it highlights what can often be a wide gap between what makes sense, which is what people suggest you do, and what fresh what feels right to them. What they suggest and what feels right to them, is a very critical mile difference, and which is what they actually do. So what's your comments on that, Samir?
No, so I think that when you look at somebody's behavior of investing, it's a lot better to see what they own rather than see what talk about.
Uh-huh.
Uh, so, I mean, the actual behavior, the skin in the game, so to speak, is uh,
Mm-hmm.
much more uh, relevant to a person's investing skill than the what they can talk about. Because talk is cheap,
Mm-hmm.
Song, yeah, that बातें बातों का क्या,
Mm-hmm.
is always possible to do.
Mm-hmm. Right. Thank you. So now let me start taking questions which have appeared and been put in the chat box. This one is from Tailab Shah. Are broad patterns not a collection of specific individual cases, outcomes, or experiences?
They are, no question about that. But at the end of the point is that you can't look at a specific case in isolation. So you are looking at a number of specific cases and then trying to derive a broad pattern from it. Is that a good answer to the question? I think so.
Yes, I think so. And in the same breath, he goes on to ask further, or rather, a comment: stop the financial goalpost moving and avoid comparison. Aren't these ideas easier said than practiced?
Simple is not easy.
Yes,
Okay.
just as complex is definitely not so easy. You are
So
right. Yeah.
simple is not easy.
So that's anyway very quick and to the point answer. Now again, these are the comments. Excellent show of content. Someone has said money has the utility value and not a happiness value. This is what Samir Parikh has observed. Yeah, and Sagar Mehta asks, author delves in individual experiences. Does psychology of money apply when our economist, finance minister, and government do their annual budget exercise? Does this psychology apply to government and uh, countries?
Of course it does. In many ways it does. For example, it is simple story. For example, it's so easy for somebody to say that, I'm going to ignore the risk, but I'm going to create I'm going to go on a spending spree. I'm going to reduce all taxes and I'm going to go on a spending spree. Okay, it has risks for inflation and so on, but I will still do it. I'm going to ignore those risks. But the problem with such a strategy is that if it pays off, it pays off, but it might lead to a situation where there is tremendous inflation and huge public uproar because of the inflation. And you create a strategy which forever you are dooming spending and reducing taxes as a way of designing a budget, for example. So at the end, that compounding works in the affairs of everything, right? So whether you're talking about an organization, a nation, or an individual, ultimately all of us have to do these little things which will allow compounding to continue and to not do those things which will break the compounding cycle.
Okay. Yeah. This Sagar Mehta, again, elongates his question, but slightly on a different dimension. He's saying, what kind of psychology of money leads an individual to the philanthropies? Philanthropy. I don't think the book has covered that, but anyway, if you want to respond, you can respond. What is the inflection point of in the psychology of money which will lead an individual to philanthropy? I mean, altruistic aspect, I think he's talking about. Anyway, you want to respond? You can please, Samir. Hello. 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 Sorry, Samir has some internet connection problem, and He is not reachable. Mhm. Then there was a question from Tailab Shah: being humble, frugal, giving up, greed are, the concepts taught in schools, but easily forgotten once you get into, the rat race. This is an observation. I think this is an observation which almost all of us will agree. Uh, Shreyans Mehta has thanked Samir Bhai for a very nice review of a very useful book on being wealthy and being happy at the same time, with greed and fear under control. Less is more and more is less. This is observation. Srikant Tapuria also comments, superb review, good hearing. Hitesh Shah, amazing review of the book. Sagar Mehta again, a stem of digital rose, stem of digital road to Samir Bhai. There is a virtual stem of rose offered to you for this wonderful exposition while carrying out a book review, and we are all thankful to you for that. Kanchan also compliments. Aditya Mehta compliments. Uh, Again, Bhavik Shah, also compliments, lots of compliments, and very understandably from Samir, Pravir, Asha Keria, and so on and so forth. So that's all about it, Samir. While you were away
Yeah, I
from
lost my
yeah.
connection for a
So all I can tell you is that there have been loads of compliments. Somebody has offered a virtual stem of rose, which I always used to do in person meeting, which unfortunately I can't do in these virtual meetings. But our soul, our feelings, and our gratitude is all expressed in this virtual offering of the stem of rose for the wonderful effort. Please stay connected with Baroda book browsers as you have been for the last 2 decades. We look forward to your abiding association. And on this note, yes, Samir, you want to say something?
Yeah, so Surendra, if you had a question, so maybe I can answer that.
Yeah, please. Yeah.
Yeah, so of course, he does say that you have to bear risk because that's the price of admission to get higher returns. I mean, that was one of his points. I hope it did. I'm sorry that it didn't come across, but he certainly says that you have to bear volatility and uncertainty and risk so that you can get investment returns. All he says is that you shouldn't bear so much risk that you don't that you will end up getting out of the game, that you will get wiped out, and so you will leave this whole business of taking risk. So what is basically important is to take controlled risks to maximize your returns, but not risks which are outlandish. And as far as Gupta is concerned, yes, it was not about staking his wealth and going down. He was guilty of insider trading, but what the point was that he did not have to take that. Basically, he didn't need more money. He didn't need the extra wealth that it would have given him. That bit of insider trading, and he foolishly in a way risked everything that was valuable to him, his reputation, his family, and everything for doing this sort of insider trading. That was the point.
Right. Good. So on that note, we conclude our this meeting of Baroda Book Browsers. Thank you, everyone. Thank you all for participating, and of course, my deep sense of gratitude continues to Samir Parikh for providing this platform, and Sambhavi Trivedi for making all this possible. Thank you all, and stay safe, stay healthy, enjoy remainder of your Sunday. Thank you and
Thank you all.
goodbye.
Thank
And
you all.
thank you and goodbye. Yeah.